being in residential real estate, right? Like you see when somebody, pulls into the driveway, like that look in their eye, like this is the home, and they want that pride of ownership. Well, residents and tenants want that same feeling when they come home at the end of the day. They want a nice quality living experience. And so being there on day one, just to ease concerns, meet people, and just by asking them, number one, we get a lot of great intelligence on things we can make. Well, we were thinking about doing this, but maybe we should add a playground versus that. But the point there is we want to add value before we ask for anything of the current residents, right?
What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Really excited to release this week's episode with John Makarewicz of Faris Capital Partners, real estate investment firm based down in Georgia. And in this episode, we dive into a whole bunch of great topics. John's got an interesting career within the real estate sector where he helped to scale a real estate brokerage to becoming one of the largest brokerage shops really in the Southeast, ended up exiting that brokerage alongside his business partner and transitioned into multifamily real estate, where they are actively buying and operating large multifamily assets in a few different markets throughout the Southeast. And in this episode, one, we talk about why John decided to exit the brokerage business, which I always think it's really interesting to dive into why somebody decides to sell a business and to exit a business. And in this situation, John shares a whole bunch of really interesting insights into the mindset of him and his partner at the time of when they sold and how they arrived at that decision. And even outside of that, I think it's really interesting as it relates to the brokerage that they were running, because they were working with a lot of the very large institutional single-family rental buyers who are just buying single-family homes at scale. So they had a really interesting kind of insight into that business as well, which I think informs a lot of how John and his team at Faris Capital Partners approaches investing in multifamily and how they transitioned into that business. We spent a lot of time in this episode talking about how GPs or sponsors can de-commoditize themselves. I think oftentimes sponsors who are raising capital to buy real estate start to blend into one another, whether it's the projected returns, whether it's how often they communicate with investors, whether it's their service offering, what have you. And John talks about how they're really making a conscious effort to not do that within Faris Capital Partners. And then we spend a lot of time for the operational folks who like to listen to the podcast talking about how John and his team really diligently manage their third-party PM companies and like what that actually looks like in practice. And they spend a lot, or I should say we spend a lot of time as well talking about what they do upon takeover of an asset, like what that first 15, 30, 45, 60 days looks like right after takeover in terms of what they're doing at a property, what they're communicating to their PM team, and what that first kind of stage from a business plan standpoint looks like. And I think that there's a lot in there for the active multifamily operators out there who are looking to get a better handle on that within their business as well. So I think this is just overall really great conversation. John is a really well-spoken guy who articulates his ideas well. And I think you guys are going to get a lot out of this one. If you do, leave the podcast a rating and review. Show us that you love it. Help it get noticed by more folks, as I always request. And again, enjoy this episode. I'll catch you guys on the next one. What's going on, everybody? We are joined by John of Faris Capital Partners. As you just heard, John and his team are doing large multifamily deals, a couple of different markets. They're actively buying right now. And looking forward to our conversation here, because I think there's an element of a couple of things I want to talk about, which we're going to get into. One, where they're buying, a little bit different than where we buy in our business. And I always like to get multiple perspectives from a market standpoint. Two, buying a little bit of a different type of asset. We're kind of the high volume, mid deal size type of business. John and his team are predominantly buying larger assets. And we're going to get into some operations related topics here as well. So I think this is going to be a great show. But John, why don't you start with your background, maybe what you were doing kind of pre-real estate, maybe talk about how you got into the business and what you guys are up to now.
Yeah, absolutely. So thanks for having me on. Looking forward to this. So yeah, I've actually spent my whole career in real estate, and it was sort of totally by accident. So I was actually at Florida State right after high school for a few years. And I was somebody who could kind of coast through high school in a sense with like A's and B's, and, occasionally use some charm and persuasion to talk my way out of a missed assignment or something. And so I kind of was like, it was like a cold water bucket in the face when I got to college and learned like what real study skills was about. So after a few years, I was bumping along and things were going okay, but I just had this kind of like almost moment of clarity where I was like, I need to kind of like reset and really decide what is it I want to do, because I just couldn't figure it out. And I came home and I was, taking some college courses here back in Atlanta where I'm from. And interestingly enough, I met a woman and we fell in love and we decided to get married. And so I had some friends that just started selling real estate. A couple had degrees from college. That was what they wanted to pursue. And we're kind of going more the commercial route, but a few that were just on the residential side. So got my license and said, I'll do this until I figure out what I really want to do. And to cut a long story short, after a few years as in, just a salesperson selling real estate, I met my future business partner, a man named Mark Spain. And over a 15-year period, we grew that business into multiple locations across the Southeast, including Texas, and had a private equity exit in 2021. So that's really where I learned leadership, management, operations. And what was amazing is we started with 9 people. When I left, there was 650. So it was really this it was my university, right? That 15 years, making mistakes, paying those stupid taxes you learn when you're building a business for the first time. And so what happened is along the way, I met Mark Faris, my current business partner. He was running a very similar business in Canada. And when you're kind of like the dominant player in your markets, it's hard to find people to mastermind with, right? Because it's like nobody wants to share with the top dog. And then on top of that, we were expanding, right? So it's like I didn't want to share things that may become, something our competitor could use against us when we went into their market. So he's in Canada, we're in the US. So that's where our relationship formed. We just befriended each other based on, having similar business and similar challenges. And so after my 2 years post sale with Mark Spain Real Estate, I decided to move on. And it was interesting. I had this vision of taking the year off and like playing golf and resetting. And Mark and I had a call scheduled in like we did, kind of on a quarterly basis. And I said, hey, I got some news for you. I decided to leave. And a week later, we're on the phone talking about Faris Capital Partners. And I never had to put a resume together or anything, right? It was kind of wild. So, but yeah, the thing that caught my attention is Mark had this very clear vision. And it was interesting because the real estate component, okay, great. Different element of real estate, but I understand that business. I understand operations and sales. What I was having a hard time wrapping my mind around is like, are we just like buying buildings and raising rents? Like, is that really all we're doing? And what happened is very early on, he was like, I want to create the best resident experience. I want to have the best investor experience. And as somebody who invested myself, I literally have $500,000. I don't mind sharing you in a deal. And I get an update once a year at best. And I usually have to follow up to get the information. And it seems to be going well, but it's very frustrating, right? And so just simple things like guaranteeing communication on a monthly basis to our investors, quarterly check-in calls. And then on the resident side, guarantees, like really adding value to the property beyond just, things like valet trash or renovated units, like, right, creating like a real culture within the community. And so we spent a couple of months talking and went to a couple conferences. I read a few books. I read Joe Fairless's Best Ever Real Estate Syndication book as an example, and decided to dive in head first. So it's been a fun 3-year journey. We're coming up on 3 years here shortly. We're about 2.5 years in. So really pleased with our progress. And, I'm sure you've covered this on this podcast, right? It's a very challenging time in this market. Yeah. But I'm really thankful for it because we have to be so disciplined and so focused to get the results. That my view is that, sometimes when you start a business in a really great market with a lot of tailwinds, you can like learn bad habits and get away with it and get lazy or make some bad decisions. So, we're almost thankful in a sense that we started this business in this more challenging time because it forced us to like really think about process and systems and like disciplined, conservative underwriting and things like that. So, so far so good. We're proud of what we've accomplished so far, but we're just getting started.
Yeah, no, I love that story. I think it's interesting. You're describing, I think, where a lot of people have had struggles who have gotten into, whether it's multifamily or different asset class, insert asset class within real estate, but that where they're raising capital, especially in that 18, 19, 20, 21, 22 timeframe. I think a lot of the folks who were dealing with some challenges over the last few years are people that got into the business in that timeframe.
Yes.
And I think there's actually something to be said for if you were, maybe you did a deal or something towards the tail end of when the market was really hot, but if you were really predominantly growing your business in the last few years, call it 2020, late 22 to now, you've just kind of set a fresh expectation with your investors where you're not dealing with a lot of baggage, which I think is really helpful. And yeah, I think a lot of folks are unfortunately not in that situation who did get into the business at times, pre-interest rate hike cycle, all of that. I'm curious as to, and this may be a little bit of a sidetrack in some capacity from our conversation around multifamily real estate, but I'm curious what drew you to driving the original business there, or I should say selling the original business, deciding to exit that, what was the timing, or was there something in regards to the timing there Was there something that actually drove that decision? Because that's a big one. And I think many
Yeah.
entrepreneurs have a lot of difficulty moving on from one business project, et cetera, on to the next. So curious as to the mindset and psychology behind that.
Yeah. So, my business partner, and he had, it was his business. And so over the years, I earned equity in that business. And so I was kind of the junior partner, if you will. So very early on, right from the beginning, we recognized that in residential real estate, like if you're just talking about a real estate agent, I mean, it's very commoditized in a sense. There's like millions of real estate agents, ostensibly all offering the same service. Now you have the top tier agents that are killer with client experience and customer service. And we hear Pareto's principle like 80-20, and it depends on what analysis you're looking at. But I know personally within some of the offices I worked at, it was really like 90-10. In other words, 10% of the agents were doing 90% of the business. But we really thought about how can we differentiate ourselves in such a way. And his experience came a lot from his father, where his father was in the building business. And so they, growing up, experienced like a recession where they went bankrupt and then had to restart and rebuild. So probably coming from that very early on, when we started growing that business, it was all about everything we need to do. We need to think about, will this be sellable in the future? And so it was always in the plan. It was always the goal. Now, he was 10 years older than me. I'm 44. So part of it too was like, you spend your whole career, 20, 30 years doing something, he'd like to kind of, what's the next phase look like? What's that next opportunity look like? So it was always within the plan. And then what really kind of, I guess, like, in terms of like building out the clearer picture, is during the Great Recession, we were hurting like everybody else in '08. And he has this thing and it's something, him and I talked a lot about. What we learned is it's not so much we like to lose or like to win, we hate to lose. Yeah. And so, that kind of desire to say, like, I know the market's terrible right now, but there's got to be something that we can do to give us an edge. So we started doing short sales. And then what happened, because we were doing such a high volume of short sales, we started getting attention from some of these groups that eventually became the SFR, the single family rental buyers. So over the years, through those relationships, we hooked up with Invitation Homes, which was backed by Blackstone. And it was interesting having a view of one of the largest private equity companies and how they came into our market with no playbook. They had a clear idea of what they wanted to accomplish, but no systems and process. And they just said, just figure it out. And all of a sudden, that exposure kind of gave us an idea that, like, maybe we're being too precious about our business and going too slow, or we're not taking bold enough action and just with our decision making, like, thoughtful about it. But that experience and that exposure really opened up our eyes to what could be possible. And so what ended up happening is all these SFR groups started showing up. And after about a 3-year period, the exclusivity that we had with that particular group went away. And so we built out a roster of about 12 of these SFR groups. And so what happened is, without realizing it, we kind of created this iBuyer program before the iBuyer program exists. And now if you're listening to this, Open Door, OfferPad are examples of iBuyers, but this idea that you go on this website, fill out a form, and get an instant offer on your home. Now, we didn't have all the technology wrapped around it, but what we were doing is we would go out to a seller's home and bring an offer with us from one of these SFR groups. And so with that, they were in all these other markets. So we're like, shoot, we can start going into these markets and offer that same thing. And that's our marketing edge. And so the decision on sell was really kind of, when is the right time? And it was interesting. We started the process in 2020 and then the pandemic happened. So we're like, so we paused. But interestingly enough, most of our offices were in the Sun Belt, where there was hardly any restrictions on our ability to do business. And we saw a huge increase in sales. So we ended up selling at the end of 2021. So even with the pandemic occurring. So it was really, I think, the clarity of knowing this was always the goal. We put a number on it, and we actually exceeded that number by 25%. But once we got the feeling that based on our EBITDA and based on where we think we would trade, we're there, that's when we started it. So it was a 10-year goal we set, and we actually accomplished it. So yeah, it was always in the thought process, interestingly enough. Now, I can't get into Mark Spain's psychology on it, but always from day one, like, we want to build something that we can sell, And look, real estate is very cyclical. So that was probably in the calculus, right? And granted, we sold in 21, right? What happened in 22? Rates tripled. So from a timing perspective, it couldn't have been better, right? So that was just one of those things that we got very fortunate and blessed and didn't even realize it, but at the time. But yeah, it was just always in the plan, So that's a top lesson I learned, is like, have a plan. And I think it's important to have a 10-year vision for your business. And so at Faris Capital Partners, we have a 2-page document, and it goes through every department, exactly what we want this to look like, from how many buildings we've taken down, how many residents we've served, how many investors. It's very spelled out, like in terms of what kind of experience we want to be offering. But at the same time, we don't get married to the steps to get there, because what I've learned in business is you can't predict when a pandemic's going to occur or a cycle is going to occur in the economy that's going to totally change the game. But when you have that clarity of the big picture vision, and you just keep marching towards it, right? It just informs everything we do. If we know we need to raise a certain amount of capital, what can we do to make the best investor experience in the world? If we need to take down a certain building, how do we build out an asset management team and a property management team that can ensure we do that? So it just creates clarity, I think, is really the idea. But yeah, long answer to your question. It was something he brought it to me. And as somebody with equity, I'm like, that sounds good to me, right? So yeah, it was always in the plan.
No, and I appreciate the thoroughness of it, because I think that a lot of folks are just building something they're working hard to build it. They understand what they want to do. They have some vague sense of maybe what the end objective is. Especially in real estate, everyone has goals around unit count or raising money or what have you. I want to get to 1,000 unit or buy 1,000 units in the next 3 years or whatever the goal might be. And there's some level of clarity around it. But I think that what many folks lack is, one, some type of thought process or plan, tactically speaking, around how to achieve that.
Yes.
And then two, like the reasoning as to why that's your goal anyways, in the first place, right? Where it's like, I know that's a number and it would be nice, but like, what's the reasoning? Does that water down to some monthly cash flow that allows you to do X, Y, and Z in your personal life? Does that allow you to, do something when you're raising money? Is that because you want to serve X amount of investors or do this or do that? Just a monetary objective. And I think actually understanding the psychology around why you're actually striving towards the goals that you are, I think is probably helpful. And then clarity as to what happens when you get there.
Yeah.
So, the fact that you guys had this vision initially of, hey, this is going to be a business that we build to sell, or at least we really want to drive towards that result and have that option, I think is there's a lesson in there just on that simple fact itself.
Yeah.
Outside of the fact that, hey, the market opportunity may be, aligned with, one, that 10-year plan, two, what you accomplished. The market probably was in a position where it was a profitable time to be selling, and there was some other factors too. But
that's right. And it's interesting because in both businesses, Mark's being real estate and here at Faris Capital, interestingly enough, like we have never really set a goal on like profit, right? Like, in other words, if we focus on how many investors are we going to serve, how many, residents are we going to serve, it's like the bottom line gets taken care of on its own in a sense, right? And so it's also about making sure you're focusing on the right things. In my experience, knowing that, for example, we wanted to sell, it helped us make decisions on spend, right? I mean, in other words, Mark and I weren't going out and buying boats and private jets, with our profit. We were pouring it back into the business, and we were just both taking a salary. And there was a couple of years we did some distributions because there was, like almost too much money just sitting in the bank. But because we had that clarity of this is the goal, you make better decisions along the way, right? Should I spend this or should I not spend this, or should we expand or not expand? And so I think that's another critical factor, and making sure your goals are the right ones, like, and thinking about, well, you've heard this term before, but like, what are the lead measures, not the lag measures, right? Lag being, we want to sell for this, but it's like, what are the things we can do every day that'll help serve that and get to that number, right? So pushing conversions, driving down our cost per lead, those types are the conversations we're having. And every year it was always a matter of how many homeowners are we going to serve this year, not how much profit are we going to make, right? So I think that's another little interesting approach that I think sometimes people make the mistake. They focus on the bottom line and not what gets you to the bottom line.
Yeah, that's a great note. And I'm trying to remember the name of the book, Four Disciplines of Execution.
That's
or something.
Exactly right.
Is that the one? Yeah, I remember reading that and being like, lead measures, lag measures. I think if that's the only thing you take away from that book, it's like, great, that's going to drive how we set all the goals within our business, right?
That's right.
It's like, to tie it back into, maybe multifamily, et cetera. When we're out there pursuing deals, we realize we're going to get an equivalent amount or a commensurate amount of deals as to the offers that we make. And then in order to make offers, we need to send out X amount of mailers, have X amount of conversations with sellers, because we got a big direct to seller component in our business.
You're right.
And we set these leading goals of offers made on a weekly period, seller conversations made on a weekly period, and that's going to trickle down, if we get those numbers right, to more deals, right? Because we're just fundamentally put more in the funnel.
And what's so cool when you do that, then it's just a math formula, right? Because if you want to increase your results next year, then it's just a simple factor of, okay, we need to send 25% more letters, or we need to have 10% more conversations, right? And you can start to see the impact. So it really is magic.
Yep. All right, let's tie this back into raising money because I think you mentioned something at the beginning of discussing the reasoning as to why you sold the business and why you guys came to that decision, talking about how residential real estate is, more or less commoditized, right? If I'm going to use the words that you used.
Yeah.
I think there are a lot of folks, LPs specifically, and then this is something that GPs therefore need to be mindful of, who think that, what we do is more or less commoditized
Yeah.
outside of a few different factors, right? It's like multifamily real estate GP, is more or less the same as another multifamily real estate GP, with outside of the fact that we have some nuances of the market in which you're buying, the types of deals you're buying, stabilized, value add, et cetera. Those typically come with a set of projected returns that, frankly, I think we would both agree the vast majority of the deals that we look at in the private real estate placement sector as it relates to multifamily real estate's all within some few percentage point in projected returns, IRRs, et cetera. So outside of like market focus, deal size, et cetera, feels pretty commoditized, I think, to the
Correct.
average LP.
Yeah.
You talked about how you guys set out to create the best investor experience, and that was going to be a competitive advantage of Faris. Let's talk about maybe how you guys think about that, like philosophically. You kind of mentioned, sending frequent updates, good communication. Maybe there's more to it than that, and then pairing that in with what you guys tactically do in the business to actually execute on that in terms of what you're doing on a monthly basis, regular basis with your investors that you feel sets you guys apart as it relates to the experience that you're providing your LPs.
Yeah, it really informs everything. So, from the idea that, if we're going to write a blog, like we're not letting ChatGPT do it. We're really trying to create something that is unique from our voice that, would add value, right? Our educational platforms, Mark and myself do have a podcast. We do 2 episodes a week. And we don't really even promote it. Frankly, we do in a sense. The only way we promote is just to our database, right? So leads that have either come in through Facebook or through our own, sort of networks, a sphere of influence, referrals, past clients, and friends and family. And, but like we put a lot of focused attention on that to like make it to where, we really want to try to unpack. So what makes us also a little bit different is most of our investors are actually Canadian. So our pitch is, hey, we're going to help you as a Canadian invest in the US. And so where this is still relatively new in the US, this sort of syndication style of investing in private real estate, it's even newer in Canada. So education is important to us. So, over the years, especially, we've even learned, when we're booking in, our inside sales team is booking in a call for Mark or myself, like we used to start pitching the deal. Now the first call is just all about them, just getting to know them, like what is on their mind, what's happening with them, why are they considering this, education. And then now we'll book in a second call to talk about the deal. And interestingly enough, sometimes we don't even have to get too deep into the weeds on the deal because we just listen to them and we understand what their concerns are and what they're trying to accomplish in their goals. But yeah, I mentioned the updates. That was number one. I mean, that was the first thing we thought of just because personally, as investors, we've experienced poor communication and how frustrating that can be. Mark literally had an investment in a startup that he learned it went bankrupt in the newspaper. Nobody even called him to tell him, right? And so extreme example, but these things happen, right? And transparent communication, that's another factor. We're not just going to give you the sunshine and like the rose-colored glasses. It's like, hey, when we bought this deal, we thought the irrigation system was broken. Turns out the well went dry. And so it is going to cost us a little more than we anticipated, but we're going to try to make up for that over here. And, then following up in the next month, here's the resolution. We were able to save some money here. We're back on track. But just that idea of just transparent communication. And then, our long-term goal, we haven't quite gotten there yet, but it's like, having like investor events, like inviting our top investors, bringing in speakers, right? So that's kind of more of our 3 to 5 year plan, but quarterly check-ins, right? A lot of our investors decline, but just, we'd love to get on a 15-minute phone call with you and talk about what's happening at these deals, answer any questions you might have. And then another thing is, it's kind of a pain in my director of finances, but we do monthly distributions versus quarterly. It's just something we thought would make us feel a little bit different. And that little dopamine hit they get every month when that, cash flow distribution hits their bank account feels good. So just little things like that. And even down to, after a conversation, sending a handwritten note, thanking them for their time, just those little touches. So those are some of the ways. Now, the biggest factor, of course, is really just a very focused, disciplined, conservative underwriting approach. So what we've learned through, and it's not like I'm celebrating this, but a lot of operators are in pain right now because they bought in 18, 19, 20. And the common theme seems to be floating rate debt, right? So when we first started talking about what do we want this company to look like, when Mark and I, we literally sat in a conference room for a few days in a hotel and just go like, what our mission, what's our vision, what's our values, like talk through all that. But we created 3 golden rules. And one is we only do deals if it works with fixed rate debt. If it doesn't, we just don't do it. We only do deals that cash flow on day one. And we always have strong reserves, typically 3 to 6 months of principal and interest and a 10% contingency budget for our CapEx program. So if we can't make a deal pencil with those 3 things, we don't do it. And then of course, beyond that, just, not assuming CoStar rent projections are correct, right? Personally driving the rent comps. Mark and I go and do that in every deal. Like we drive the comps and we don't just drive by them. We get out and we take a tour, we check out the units and, it saved us a few times. We had a deal we were looking at in Atlanta and we thought it was a winner. And then we've toured a comp and we're like, we're not going to be able to compete with this. Like our rents are going to be at least $50 to $100 less than this property. So we backed away. Right. So just having those rules in place and those fundamentals that you don't deviate from are a big factor, because ultimately we can send all the updates and distributions, but if the returns aren't there at the end of the investment, it's going to be a bad experience, right? So that's another big factor. Interestingly enough, we've started thinking a little bit more about the residents in terms of, if you think about it, what's the biggest impact on the bottom line? It's happy residents, right? That are renewing. And so we put a lot of pressure on our property management and asset managers to deliver an exceptional experience. And I don't mind sharing with you, we have a property in Florida and, it's an interesting time, right? We, on one hand have to honor fair housing, right? National origin. So these people were here legally, had no criminal history, but ICE came on property and removed 3 of our residents. And, just working with those families. And in some cases, their family came in and tried to pay the rent. And we said, look, we'll be happy to accept, but you might want to talk to a lawyer first to make sure, because they might not be coming back. And I'd rather not take your money and then you can spend it over here. So, somebody has a health issue, not evicting them, working out a payment plan. And gosh, simple stuff, making sure the sales center or the leasing center, I should say, is open. That to me is the simple table stake stuff, but so many operators just trust their property managers. And I know personally, because I, once again, tour rent comps, how often do I pull up and there's a sign on the door, call my cell phone if you want a tour or something, And so that resident experience also in turn helps the client investor experience, because, we're looking out for the bottom line first and foremost.
Yeah, I think it's so funny. I remember, because we started buying, like I personally started buying in 2016, started raising capital in 2019, 2020 without really gaining real traction until 21. I was one of those guys who started raising LP capital as COVID hit. And luckily we were in markets doing deals that had plenty of margin and we've been, doing just fine. But the funny dynamic, I think, of how the conversation around asset management has changed from then till now is back then it was all about, it's always all about leasing. So I don't want to say it's not now, but at the time it was always about leasing in the sense that there's no conversations about renewals or maximizing renewals or tenant experience or any of that stuff. It was, if somebody leaves, that's fine. We're almost encouraging that because we want to mark the lease to the new market rents or mark the unit to the new market rents. We're going to, we can't push 7, 8, 10% on a renewal. It's pretty challenging to do that. So if we got to turn it over and lease at a new rent and continue driving that rent roll, that's fine. And the rents were increasing at such a pace that didn't require such a focus on renewals. Whereas over the last few years, it's completely flipped, right? We've wanted to, maximize occupancy, increase renewal rate. And, I think the tone of the conversation around asset management has changed so significantly as a result of that. So let's dive into that a little bit more. So I guess at a high level too, curious as to, I know you guys work with third party right now. We were talking kind of before we hit recording, maybe at some point it's something that you'd like to bring in-house in the future, but currently working with third party.
Correct.
What does the asset management process look for you guys right now in terms of recurring systems, processes, things that you do to make sure that you're doing a good job of managing your PMs, asset managers, et cetera? And then we can get into some of the things that you look to do when you take over an asset and, what a typical business plan looks like.
That's right. So kind of the first thing, right? Mark and I starting this business, we go, look, we're both successful entrepreneurs. We've created big businesses, but this is still new to us, right? And so Mark had personally, built a portfolio of like $30 million in real estate over 20 years. And so he had experience. I myself, invest in real estate. but we knew we needed to go out and find the team. So we were fortunate in that because we had these other successful businesses, we were able to front end the company with, some good funding so we could do this, right? So we hired an asset manager immediately, even before we took down our first deal. Now, part of that incentive there was that because Mark had this personal portfolio, he could have her oversee some of them and save some money with some third parties. But then that way, when we found a deal, because we had an analyst at that time, we would also have a strong asset manager. Now she has 20 plus years experience. So, it was an expensive hire, but it was well worth it. So when we're looking at these deals, we had that seasoned asset manager because ultimately she's going to be the one held accountable to the pro forma, right? So if she wasn't agreeable to it, or she thought we're being too aggressive or not aggressive enough, she would help us make those decisions. Now, from a day-to-day, like managing the PMs, number one, we started out working with a couple of different property management firms. That's generally how I start. But my goal as a business leader is to then really get down to a firm, strong relationship with one vendor. And you may go out and shop the market a little bit on maybe an annual or, couple year basis just to keep everybody honest. But when you have a really great vendor and you can form a tight relationship, to an extent, it gives you some power. So in other words, we have a team that is consistent across all of our deals. So our regional is across all of our deals, and she will always be a part. Now, she can only do 8. So once we cross over 8, we'll bring another one in. But it's that idea. So we only have to talk to 2 or 3 people over there, right? The marketing person, the regional, and the division president. Then from there, so our asset manager, I would say, is just, and I say this with love, but she's probably just one step shy of micromanaging them. And in other words, we have 3 huddles a week with the PM teams where it's 15 minutes and every property manager. So it's not all the leasing manager and maintenance supervisors and all them, but the PM at the property, they're reporting on, their number one accomplishment for the week, a couple key metrics, and the number one thing they have to get done before the next huddle. So every day we're connecting with them. And then we have a weekly meeting for each property where they go through just the lease trade outs, the box scores, and, on a monthly basis, those financials. And then internally, when we receive those financials, she goes through and audits them with our director of finance. And then we do a comparison to our pro forma. So we're always tracking progress. Where are we falling behind? What's happened is, you mentioned the renewal thing. We've had such strong renewals. And for example, we took down a deal in Charleston and we were doing 8% renewals to try to get some people to leave so we could renovate a unit. Yeah. And they accepted. We went to 10%. They accepted. So now we're like, do we have to go to 12% just to get some people to move out so we can renovate some of these? So, that could be a thing, right? And so with that, it's okay, so we have to save somewhere so we stay on track to hit those pro forma numbers. So looking at things like expenses, and we've been fortunate. We have one deal in Florida and our insurance got cut in half in year 2. Now I anticipate it will go up again, but sometimes you get those wins that, are completely out of your control. But it is a very much micromanaged process, but with love. She comes alongside them. It's not barking at them, but they know we know we're watching, right? And so it's that is one of those things that's super important. So high level of trust, but it's like Ronnie Reagan said, trust but verify, right? So, we look at the numbers. And for example, she's in Charleston all week this week. We just took down a new deal. So she's there for 2 days and then she's touring the other 3 the following 3 days. So, we do spot checks. Sometimes when I'm, for example, going to be down in Tampa, I don't announce to the team I'm going to be there and I just swing by, and I don't do it to try to catch them doing something wrong. But we did have a deal in Charleston and I did that. And I picked up half a bag of trash personally and walked into the leasing center with it. And that was the first time they knew I was there for the day. I said, guys, what is going on? Yeah. I just did this in 30 minutes. You guys have been stepping over this stuff for 3 weeks. What's the deal? Now I wasn't screaming and yelling, but it was that opportunity for them to see it's not beneath me to pick up the trash. So it certainly shouldn't be beneath you. Right. So those are some of the things that we do, but I would say it's a very, number one, you have to have the right property manager. You have to really, really spend a lot of time ensuring that they're the right group. And then you have to put the systems in place to hold them accountable. Once again, you can do it with love, right? But at the same time, it's they know we have strong, high standards. And so, for example, when they bring on a PM, they deliver us the top 3 candidates and we meet with them. And then the team, including PM, makes that final decision on that hire. Because we found sometimes, right resume, all the right stuff, but they just don't like people. And somebody comes in complaining about something and they bark at them. So it's important to us that we also are included in that hiring process at the asset level. So some property managers would probably hate that and tell us to pound sand. That's okay. But we found the one that was willing to work with us on that.
Yeah, I mean, that's huge because I think that fundamentally speaking, the more layers of communication between what's going on within an apartment at a property and the ownership of the asset, the more layers of communication, more layers of people that it's going through, the more likely it is for things to slip through the crack, for things to go overlooked, for decisions to take longer to make, for all of these different things that fundamentally downstream affect NOI, which is the only
Yeah.
thing we're obviously really caring about at the end of
Yeah.
the day here is driving NOI and continuing to maintain NOI.
That's right.
And I think organizationally speaking, especially for a business like yours, where buying larger assets, working with third party, it's trying to figure out at the ownership level, like how do I insert myself all the way down to the lowest rung of the process in some periodic manner to which they understand that, the property manager at the property itself, or the leasing agent at the property, or whoever's, the maintenance guy who's handling the work, or the GC who's actually executing the unit turns that may be managed by the PM, who's then managed by the regional, who's then managed by the owner. It's like getting down to the lowest rungs will actually create a ripple effect that works all the way back up the chain in the sense that there is some level of oversight, even if it's random, periodic, etc. And I think that it's just tough because I think a lot of owners find themselves in bad habits where they're like, my PM is great. And I think it's great to have a PM that you have a great relationship with who's doing a good job. But even the best of PMs, let alone mediocre PMs or bad ones, will get complacent over time, right? It's like the building's at 92%, that's good enough. That's above where we talked about where we wanted to be when we were talking, setting the budget for this year, whatever. We got there, you start to take your foot off the gas a little bit. You're not picking up the trash, as you said. We're maybe not being as quick in processing rental apps as we were when we were below 90 and you were really on our back. But, the whole difference in success from an asset management standpoint is like, can you go from that 93.4% occupancy to 96, 97? Like that incremental 2% has such an outsized impact on NOI and free cash flow and returns that it's like, that's really where the margin is, right? And it's like, how do you create that little margin? It's by getting a little bit more involved, fundamentally speaking.
Yeah. Aligning incentives. So we actually with our PMs, if they exceed our pro forma targets for the year, they get a piece of that, so they get a little taste. And so they're incentivized, right, to exceed performance, right? So really thinking about the compensation and is the bonus, or whatever the program is that compensation aligned with your goals, right? And so that's something we do as well.
I love it. Talk about, we haven't even really discussed yet outside of just generally speaking, you're talking about Charleston, South Carolina, Tampa, you're in Georgia. Obviously, it seems like the market is kind of the Southeast US, right? You got a couple of different markets there. So assuming that is the market, let's talk about what you guys are typically buying from a deal standpoint, class of asset. Is it value, heavy value add, light value add, more stabilized deals? And then with that context, let's talk about kind of the big three things that you do when you take over a deal in terms of like what the core objectives are from a business plan standpoint, at least in a typical deal that you guys are looking for.
Absolutely. Yeah. So we're actually in the process of doing a research project on some additional markets that we should be considering. So primarily in the Midwest. We originally started in the Sun Belt, but specifically in Florida, because I mentioned the Canadian component. And we do have a lot of investors in the US too, but we target the Canadians because my business partner's Canadian. And he personally was just finding it almost impossible to find cash flowing real estate deals in Canada. It's a very different world up there. I'll just put it that way. Their tax system, I mean, high income earners are paying 50%, but you look at real estate, the prices are through the roof. Their mortgage, world is so different from ours. So even for like a single family home, you're doing like 5-year mortgages. And so it just became a thing for himself where he couldn't find cash flowing real estate deals. And so he's like, well, certainly if I have this problem, other investors do as well. So the original thought process was Florida because a lot of Canadians vacation in Florida. And we were probably like underthinking it a little bit, but we're like, they know Florida. It makes sense to them. A lot of high net worth Canadians even have homes in Florida. And what was interesting is it went well. We raised the capital, but their next deal was in Charleston. And some repeat investors or investors that didn't invest in the Tampa deal mentioned that hurricanes were on their mind and insurance was on their mind. So that was actually a moment where we're like, okay, so we don't have to be so focused on like these key markets that just have that name recognition. So our newest deal we're closing in a few weeks. I'm not sure when this exact will air, but we're closing October 15th, is in Atlanta, Georgia, just south of Atlanta, a little market called Noonan. So we're looking all over the Carolinas. So primarily in like the Raleigh, Durham, Cary area, Charlotte, Charleston primarily is the only market in South Carolina, Metro Atlanta, and then Central Florida. So we're looking to expand into some additional markets because deal flow is constrained right now, and we're just not getting the at-bats we need in those markets. So we need to open up a few additional markets. So still in the process of doing that study, but looking at some markets like Bowling Green is one that's come up that's had some strong. Plano, Texas was another one that has some strong, metrics and indicators that we like. So we're still in that process, but that's really where it came from. It initially started in Florida and we just weren't getting the opportunities there. We looked at Charleston. From Atlanta, I go to Charleston a lot. I had friends that went to college in Charleston. It's a great city. So, typical stuff, right? High population growth, job diversity, affordability, that's a key factor. We like to see our post-renovated rents where the median and average income in that 5-mile radius is at or below 30%. We've done 32, but we like to keep it below 30. So that's how we start to think about it. And then we look obviously at things like crime, schools, that. As far as asset classes, we're typically targeting B-class assets in A or B areas that I would say are kind of medium value add. Like our perfect scenario would be like, an 80s or 90s building that's had some light renovation, but is dated, right? So largely all classic units. 144 units we took down in Charleston were built in the early 2000s, all original condition. So carpet, Formica. So we went in and did premium renovations. And so our thesis is we want to be able to force appreciation through the value add of the unit renovations, but then create a product that feels like a value as compared to maybe that Class A building down the street. So it has all the LVP, flooring, granite countertops, designer lighting, designer bathroom and kitchen fixtures. We put in the soft closed drawers, really try to make it feel like, okay, this is very similar, but I'm paying $400 less in rent over here than I am at that Class A. So the goal of kind of being the nicest Class B asset in that market or that submarket is our goal. That's what we do. And I think our thesis on that really boils down to, we provide really quality housing for a demographic that often is underserved. But if we were to hit a recession and somebody in a Class A is looking to save $400 or $500 in rent, they'll feel comfortable maybe coming down to our asset because it has all the bells and whistles, but maybe just 10, 12 years old or 15 years old versus brand new. So that's how we think about it.
Love it. And then let's just say, maybe we use a deal that you've done as an example, right? Maybe it's these 144 units in Charleston or just, I know you guys are working on a deal right now.
Yeah.
Big three things that you like to do after you close in terms of we want to do this, we want to do that within this time frame. This is why we want to do those things. What's kind of like you close, what are the first things you're trying to accomplish post-closing on an asset?
Absolutely. So first, we're always on site the day of closing. So the day we take ownership, the asset manager and typically myself are there on day one. Obviously, our property management team as well. What I've learned very quickly in this business and knowing that, sort of in a normal market, it's changed a little bit today, but, these assets trade every like 5 to 7 years. So, for example, the deal we just closed in South Carolina in Georgetown, we have residents that have been there for 25 years. And so they've seen multiple owners. And what they often see is new ownership, nothing really changes, but the rent goes up. Yeah. And so being there on that day one, just to try to have the leasing center open, bring in some refreshments. We even get dog treats and things like that. And we catch any resident we see walking around, introduce ourselves. We've got our polos on, say, hey, we're the new owners. We just wanted to say hello. And then we ask them, what do you like about the community? What do you don't like? Is there something you'd like to see that can change? And for example, we have to replace all the roofs on this particular building. And a gentleman walked in to pay his rent. And he was like, wow, you guys are doing a lot, because on day one, we started, trimming trees and pressure washing and all this stuff. And he mentioned something, and our property manager who was speaking with him. And she said, well, we're going to be replacing the roof. So, apologize for some of the disruption, but by the end of this, you're really going to love it. He goes, oh my gosh, every time it rains, my bathroom leaks. And she says, you won't have to live like that anymore. And turned around and kind of got some paperwork, turned back. The guy had a tear in his eye. And he said, yeah, I've been here for 10 years and nobody's ever said something like that to me, And so we really view these being in residential real estate, right? Like you see when somebody, pulls into the driveway, like that look in their eye, like this is the home, and they want that pride of ownership. Well, residents and tenants want that same feeling when they come home at the end of the day. They want a nice quality living experience. And so being there on day one, just to ease concerns, meet people, And just by asking them, number one, we get a lot of great intelligence on things we can make. Well, we were thinking about doing this, but maybe we should add a playground versus that. For example, the deal we're closing in October has a basketball court. We were thinking of converting that pickleball. We talked to a bunch of residents. They're like, please don't. We love to use it, And our property manager was like, they take care of it. They don't trash it. It's not like, for those listening, sometimes basketball courts can unfortunately attract people from outside the community and a rough crowd. And so, but they self-police. And so we're like, we're going to listen to the residents on that and not convert that. They like it, right? So that intel. Now, number two is, I sort of touched on this, but we have what we call the 28-day full out transformation. So from day one of ownership to day 28. Now, there's a little bit of marketing in that 28 days. Sometimes it takes 45. Certainly, we're replacing roofs. We're not going to get all that done in 28. But what we want to do is replace all the exterior lighting on the building, paint the doors, pressure wash, if we're painting, enhance the pool furniture, and we build pergolas and grilling stations. Maybe we add a dog park, and we try to do all of that within that first 28 days. Sometimes it takes 30 to 45. But the point there is we want to add value before we ask for anything of the current residents, right? So I think what some operators do is like, well, we're going to do the, dog park. We'll do that next year. We'll do that in 6 months. But they're asking for a 7 or 8% rent renewal. And so to that resident, they're going, what did I get for this, right? So by coming in hard and fast, improving the overall look of the asset, trimming trees, all the stuff, enhancing the landscaping, we made it a better living experience. So when those renewals come through, they're more likely to accept. So that's number two. And we've also kind of touched on this too, but number three, like, just don't assume the property managers are on it, right? I mean, even if you have great property managers. So that first 30, 45 days, myself or our asset manager are effectively there every week, at least for a couple of days, if not the full week, just making sure the work's happening, things are moving along. And by being there, sometimes what happens is, a plumber comes up and says, hey, there's another way we can approach this problem. And you can just approve it right then and there versus an email and then their 3-day delay or something because you didn't get to it. So really being on site day one, doing as much work on the exteriors and the amenities as possible in that first 30 to 45 days. And then just, I'll say it, but micromanage the property managers to ensure everything's that you expect to happen is happening. I think if more operators did that, they would see much better results in the long run.
Yeah, no, that's so killer. I mean, in our PM company, when we're working with third-party folks, which I mentioned to you before we started recording, like we do some third-party management, and we predominantly manage a lot of these smaller scattered site buildings that are a little older, just given that's the New England housing stock. And part of our process that we've had to make owners comfortable with, because we have a lot of varying levels of sophistication on the ownership side, right? We got a guy who owns a 10 unit that he inherited, and then we have some guys who owns 150, a couple hundred units that have some experience that maybe have a different way of viewing the process of property management. And something that we do as a core process when we take over a building is just send a message to every resident at the building saying, hey, let us know if you have any maintenance requests. Is everything working okay? And it's like the most simple thing to do, but you immediately, even if there's nothing there, they're like, wow, no one's ever proactively asked if something's wrong in my apartment. Right. And I think the other piece of it is like so many residents just don't submit a maintenance request because they kind of, a lot of folks, your sink's leaking a little bit when you run the garbage disposal thing. You kind of just deal with it, right? You got a little paper towel under there. You don't really do anything. But, you'd like to have it fixed, but you don't really feel like going on the app and like doing, submitting the maintenance request and having somebody come to your house and doing all that. But like if you're prompt and if you're asked and if it's like an encouraged component of living there, there's a bit of a different psychological approach to that, right? Yeah. And like we've had some owners who are like, well, we don't want to like actively create work orders and do all of this and like spend more money on maintenance if we don't need to. And there's part of the education, I think, for a lot of owners and operators is, yeah, but downstream, you're improving the quality of the community in the sense that everyone there is a little bit more enthusiastic about living at your building, right?
That's it.
And even if you're not going to define this in, you're going to try to downstream track renewal rates, which is maybe how you could track that, et cetera. It just makes for an easier management process in regards to all the conversations you're having with the folks of the building. Your PM staff is much happier because everyone's a little bit more positive when they come into the office.
That's right.
And yeah, if you pick up any incremental increase in your renewal rate, it's all going to wash out, right? And the dollars that you're spending on this and the time that you're spending on it, right? So I think a lot of owners, especially I think owners who and maybe I'm unfairly generalizing here, but folks who have been in the business since the 90s, the early 2000s, et cetera, there's kind of this approach to property management where it's a little bit more adversarial. It's a little bit like we're on this team, you're on that team.
Yeah.
And I think over the last few years, I don't know, I can't trace it to anything specifically, but I think there's much more of a service mindset around property management and asset management fundamentally. And I think that, the operators who are embracing that are doing just better from a actual performance at an asset standpoint, regardless of the class of asset that you're investing in, whether it's A, B, or C. And you guys are taking that to the umpteenth level, which I think is great to highlight.
Well, and you mentioned something there. So another thing we do is we have 3 resident guarantees. So number 1 is happy in your home. So if in the first 30 days you just realize this is not the right fit, it could be you miscalculated your commute or whatever, we'll release you of the lease. Now, we're proud to say nobody's taken advantage of that yet, but our idea is that's actually a benefit to us because if somebody's unhappy in the first 30 days, they're probably going to be a thorn in the side of the property manager for the next, 12 months, right? So if they're unhappy, I learned long ago in business, like make it easy for people to stop doing business with you if they're unhappy, right? Like, so at our real estate company, we didn't charge a contract break fee as long as we weren't under contract. If you had a listing agreement with us and you just didn't want to do business with it anymore, we released you. Number 2, in your corner. So major life change, such as a job transfer or downsizing, or maybe a family member gets sick and you have to move cross country to help them. Just document that. We'll release you of the lease. We kind of got that one kind of thinking about how we treat the military, right? A deployment, we release them of the lease. But it also benefits us because if something like that were to happen and we held their feet to the fire to the terms of the lease agreement, then it's highly likely that they're going to skip or, just stop paying rent or, God forbid, maybe trash the unit on the way out, right? But it's also because we love people and we know that we'll be able to get somebody else in there, right? And then 3, we guarantee maintenance requests. If it does not require a part to be ordered, we'll do it within 24 hours guaranteed, or we give you a $50 Visa gift card. So we even wrap some incentives around it and some guarantees. So, but I love your thought of just like, sending out a survey maybe, or, when you're on site, just asking, hey, is there anything in your unit that needs to be fixed? Right. To me, it's such a small thing, but think about it. That little small leak over time, now I got to replace the bottom of the, the box, right? Potentially. Exactly. Right. But it's like, if I solve the leak and I move on, they're happy and I'm happy, and it actually helps the bottom line in the long run. Right. So very good thoughts.
100%. All right, John, this has been great, man. I appreciate you taking the time. We got into a lot of great topics and went pretty deep, which I always appreciate when guests do that. So thank you for kind of sharing your playbook and being generous with all of everything that you've learned since you guys have started this over the last few years. Where can folks reach out to you, learn more about Faris, get on your email list, all that fun stuff?
So just Faris Capital Partners, that's FARIS, capitalpartners.com. We also have a little landing page called fulloutinvesting.com that you can go to where we have a sample deal and you can book in a call with us or get added to our deal alert list.
Love it. Thanks again. Appreciate the time.
My pleasure, Axel. It was great. Thank you.